So the July DMAR's Market Trends Report just was published for June 2019 data. But I want to start higher than that. I want to start out at the economic level and talk about what's going on globally that's impacting our local housing market. So let's start out with GDP, right? GDP and inflation are the two biggest topics. GDP first quarter just had its third look. We don't have GDP second quarter numbers out yet. And GDP first quarter remains strong. In fact, record-breaking numbers, 3.1% growth in the first quarter. Now, a lot of experts will say that it's artificially inflated due to people hoarding inventory in front of the trade wars. So if that's the case, what is GDP second quarter going to look like? We're still waiting. Inflation is also very stable. In fact, it hasn't moved in several months. We're sitting at a headline PCE inflation number of 1.5%. Core, if you strip out medical and housing, is 1.6%. Still well below the 2% Federal Reserve goal number. If that's the case, the Federal Reserve has to take this into account as they lower their Fed rate, because lowering it too fast or too much could result in a de-inflation, and we don't want that. What else is going on? Jobless claims have been barely ticking up. We talk about unemployment all the time, that when unemployment bounces back up again, that's also a sign that the recession's coming. Jobless claims are barely ticking up. It's the highest it's been in 7 weeks, but it's not much higher. ADP and BLM also put out a job creation number, and those are also weak. So what's happening is companies aren't necessarily letting people go yet, but they're not hiring either. We also have the 10 and 2-year yield that we've been watching for when it inverts. Because when it inverts, that means that another sign that the recession's coming. It's not doing it. But they're all almost identical. The 10-year, 1, 2, and 5 are almost yielding the same rewards, meaning short-term money and long-term money is almost equal. So why do you even care, right? I mean, because if we've been talking for any length of time, you know that I always talk about this fact that, well, if you're in front of me driving, get out of my way, because I'm in the fast lane. Well, I saw the police up ahead, right? And all of a sudden, we had to move over to the slow lane. But if you scroll back to July 2018, it was almost as if we were going to fall off a cliff. People thought the bubble was about to burst. That didn't happen. All we did was move over. We started to go slow and steady. And we want that. It means a balanced market. It also means a stable economy. You can't run that hot for too long. And as you know, we just passed the longest expansion period by 10 years and 1 month as of July 1st. So what does this all mean for DMAR's 11-county area? So we're halfway through 2019, and slow and steady is going to win this year. So inventory hit another record number since October 2013 with 9,520 homes for sale. Under contracts remain strong, over 3% growth from last month, 11% growth from last year. Demand's still up. Mortgage purchase applications are up 9.2% from last year. And months of inventory remains low. In fact, we're below 3 months of inventory for condos all the way up to 750, and for single families all the way up to 1 million. Now, you might say that we're heading towards a bifurcated market, meaning we've got stronger demand at the lower price points, more inventory at the higher price points. That's still to be shaken out as we head towards a balanced market. Days on market is also going up. It's up 66% for the median home price, up 25% for the average. And our median sales price was up 25%. I'm sorry, I wish, right? Our median sales price was up 1.9% year over year. If it was up 25%, I'd just retire right now. It was up 1.9% year over year. But I want to talk about that just for a second, because in the DMAR Market Trends Report, we use the median sales price as an indicator towards appreciation, right? It gives us the amount by which, or the speed by which, we're gaining ground in our values, our home values. There's a better way, and there are data aggregators that look at billions of records of data over 50 years, comparing individual homes each time they sell or refinance and what the value of that home is. Well, from that perspective, they come out, they're about a month behind. So for May, they showed a national appreciation of 3.6% and a Denver appreciation of 4%. Now that's a house-to-house comparison. So that's money that you can count on. So, do I buy, sell, or wait? Case-Shiller went on to forecast the next year. So looking back May 2020, we are expected to see a 5.6% appreciation year over year nationally. We know the Denver market runs hotter than national levels. So what can you expect next year? We also are anticipating that when the Federal Reserve Board meets on July 30th, that they're going to lower the Fed rate by a quarter, maybe even by a half. That is going to ripple towards our long-term rates. Now remember, the Fed rate impacts short-term rates. It's the market's expectation of the Fed rate, which is actually keeping rates low right now, of what they're going to do that's going to continue our rates into the future. So the opportunity is really phenomenal for both buyers and sellers. I mean, if I look at this, and as a buyer, if I know that I'm expecting that appreciation is going to continue, if I'm seeing incredibly low interest rates, in fact, the lowest interest rate since November 2016, if I've got slowed appreciation, which has increased my affordability, now's the perfect time to get in. And if I'm a seller and I'm able to take advantage of all that gift of equity that I received for the last 5 years and know that I can get back into the market at today's low interest rates and still see an increase in value in the future, well then what am I waiting for? Because even with a recession, we know that only 2 times in the past during a recession have home values lost value. And in all of them, interest rates go down. So the opportunities are abound. So whether it's a roof over your head or that next investment, if you're looking to take advantage of the Denver market, there's no place I'd rather be. And if you have questions on how to do that, well, then you need to give our team a call because we'd love to go to work for you. Well, my name is Nicole Rueth with the Rueth team of Fairway Mortgage and proud member and sponsor of DMAR's Market Trends Committee. I look forward to talking again and seeing you next month. Bye-bye.